Have you ever wondered what happens to the world when the ultimate safety net finally snaps? Right now, we are witnessing a financial event that was once considered impossible. Gold has just shattered every record in the books, surging past the $5,200 mark. This isn't just a small price jump. It is a massive signal that the global economy is screaming for help. For decades, gold was the boring asset in the back of the room, but today, it is the loudest voice in the market. While the headlines focus on daily stock swings, the real story is hidden in this unprecedented trade shock that is rewriting the rules of wealth. But why is this happening so fast? And why should you care if you don't even own a single ounce of gold? The truth is, this surge is a direct reflection of a world on the brink of a geopolitical shift we haven't seen in our lifetime. In this video, we are going to pull back the curtain on the secret drivers behind this $5,200 explosion. We will look at why central banks are suddenly hoarding bullion like it's 1929 and what this means for your personal savings and the cost of living. If you stick with me until the very end, I'm going to share a specific gold-to-silver ratio strategy that historical data suggests could be the biggest opportunity for regular investors during a price spike like this. You won't want to miss that, as it could be the difference between just watching history happen and actually profiting from it. Let's dive into the chaos and find out what is really going on. The real engine behind this gold explosion is a perfect storm of global instability. We are currently watching a massive military buildup in the Middle East that has the entire world on edge. With 2 U.S. aircraft carriers stationed in the region and tensions with Iran reaching a boiling point, investors are terrified of what a sudden conflict could do to the global energy supply. History shows us that when the threat of war looms, people don't look for profits, they look for protection. Gold is the ultimate crisis currency because it doesn't depend on any single government's stability or any central bank's promises. It is a tangible asset that has survived every empire and every war in history, which is why we are seeing such a violent move towards safety right now. But it isn't just about the threat of kinetic war. We are also in the middle of a massive legal and political battle over trade. A recent landmark Supreme Court ruling just struck down the administration's sweeping global tariffs as unconstitutional. This decision didn't bring peace to the markets, it brought total confusion. In response, a new 15% flat tariff was announced almost immediately, effective today. This tariff chaos has created a massive hole in government revenue projections and left businesses with no idea how much their goods will cost tomorrow. When the rules of global trade change overnight, the safe haven demand for gold goes into overdrive. Investors are effectively betting that gold is more reliable than the laws and treaties that used to govern the world economy. Moving from global conflict to our wallets, we have to look at the massive trade shock that just hit the fan. On February 20th, the U.S. Supreme Court dropped a bombshell ruling, striking down the administration's sweeping global tariffs as unconstitutional. You would think that removing taxes on imports would be good for the markets, but it actually triggered a wave of tariff chaos. Within hours, the administration fired back by invoking a rare emergency law to slap a fresh 10% and eventually a 15% flat tariff on almost everything coming into the country. This back and forth isn't just a political game, it's a direct hit to the stability of the US dollar. When investors see the legal foundation of a country's trade policy crumbling and changing overnight, they stop trusting paper and start buying gold. This leads us to a word most people haven't heard in years: stagflation. We are seeing a dangerous combination of slowing economic growth and sticky inflation that refuses to go down. Even with the Federal Reserve keeping interest rates high, the cost of living is still climbing, and these new tariffs are expected to add hundreds, if not thousands, of dollars to the average household's yearly expenses. Usually, high interest rates make gold less attractive because gold doesn't pay a dividend. But right now, the fear of a trade war is so high that gold is completely shrugging off those traditional rules. People are realizing that if the price of goods goes up by 15% because of a tariff, gold is one of the only ways to make sure your purchasing power doesn't vanish into thin air. When gold hits $5,200, it sends a shockwave through the entire financial system. This isn't just a number on a screen, It is a fear gauge that tells us exactly how worried the big players are. In the stock market, we are seeing a massive split between winners and losers. Companies like Apple and Walmart are struggling because the new 15% tariff surcharge makes their products more expensive to import. On the other hand, gold mining stocks like Newmont and Barrick Gold are soaring. Investors are pulling money out of traditional tech and retail stocks and dumping it into anything related to precious metals. This shift shows that the market is moving away from growth and moving towards survival. But the most important thing to watch isn't just what individuals are doing, it's what governments are doing. Central banks around the world, from China to India, are hoarding gold at a record pace. They are trying to diversify away from the US dollar because they see the trade shock and the geopolitical tension as a sign that the old financial rules are breaking. When the people who print the money start buying gold, it tells you they are worried about the value of their own paper currency. This massive institutional buying creates a floor for the price, making it harder for gold to drop back down to normal levels. We are entering a period where politics moves the market faster than the Federal Reserve ever could. So, with gold breaking records and the global economy in a tailspin, what should you actually do? The first and most important rule is, do not panic. When you see a price tag like $5,200, it is tempting to jump in with everything you have because of the fear of missing out. But remember, the market never moves in a straight line. Chasing a vertical rally is often how retail investors get caught at the top. Instead, professional traders look at this as a time to review their insurance. If you already own gold, this isn't necessarily a signal to sell, but rather a confirmation that your hedge is working. If you don't own any, look for pullbacks or temporary price drops to $5,150 or lower, which we've seen even in this bullish trend, to build a position without overpaying. Diversity is your best friend right now. While gold is the headline act, it shouldn't be your only performer. Investors are increasingly looking at split asset strategies, balancing their gold holdings with other hard assets that perform well during trade wars. This includes everything from silver to high-quality energy stocks. You also have to keep an eye on the bear case. As strong as gold looks, a sudden de-escalation in the Middle East or a surprise peace treaty regarding trade could cause the risk-off premium to evaporate quickly. Always keep some cash on the sidelines. In a world of 15% tariffs and $5,000 gold, liquidity, having money ready to move, is just as valuable as the metal itself. To wrap everything up, the $5,200 mark for gold isn't just a number. It is a historical warning. We are living through a unique moment where trade policy and global tensions are moving the markets faster than any central bank could. Gold has proven once again that when the world gets complicated, investors return to the basics. Whether you are looking at your retirement account or just trying to understand why your grocery bill is rising, the gold signal is clear. Volatility is the new normal. By keeping a cool head and focusing on long-term protection rather than short-term hype, you can navigate this trade shock without losing your shirt. As I promised at the beginning of the video, I want to leave you with a specific strategy regarding the gold-to-silver ratio. Right now, even though gold is at $5,200, silver is sitting at around $87 per ounce. This puts the ratio at roughly 60-1. Historically, when the ratio is in this range, it's a neutral zone, but keep a close eye on it. If that ratio climbs back toward 80-1, history shows that silver becomes the massive catch-up play, often gaining twice as much as gold in the following months. Many pro investors use this exact moment to rotate some of their gold profits into silver to maximize their gains. If you found this breakdown helpful, make sure to hit that subscribe button and turn on notifications. The market is moving fast, and we will be here to help you make sense of every trade shock and price surge. What do you think? Is gold headed for $6,000 next, or is this the peak? Let me know your thoughts in the comments below. Thanks for watching, and I'll see you in the next one.